Good afternoon, everyone. My name is Kim Schoenholtz, and I'm delighted to welcome you to the 16th NYU Stern Economic and Market Outlook Forum. The host of today's forum is the Stern Center for Global Economy and Business, which serves the university through outreach to the broader community, including the academic, business, and policy worlds, as well as students and alumni. We're especially pleased today to have here students and faculty from all over NYU, as well as numerous alums. Thank you very much for joining us. Today's program will last about 85 minutes. It will begin with presentations of 5 to 10 minutes by each of the panelists about economic and market prospects, followed by audience Q&A. We'll finish by 6:30 p.m. Please note on the screen, there we go, that you can submit questions to the panel using your smartphone by going to the website www.slido.com and entering the code number 4444 in the box labeled Join. You can also vote on the questions that others have submitted. Your votes will help us judge the issues that are of greatest interest to you. Let me now briefly introduce our distinguished panelists, starting with Louis and moving to Miki and Subhadra. Louis Alexander is the U.S. Chief Economist at Nomura. Before Nomura, he served as counselor to Treasury Secretary Timothy Geithner. He also had been Chief Economist of Citigroup. Earlier, he led a distinguished career at the Federal Reserve Board, eventually becoming the Deputy Director of the Division of International Finance. Louis obtained his PhD in economics from Yale. Miki Levy is the Chief U.S. and Asia Economist for Berenberg Bank. Previously, he was Chief Economist at the Bank of America. Since 1983, Miki has served on the Shadow Open Market Committee, a group of academic and business economists that comments on the actions of the Federal Open Market Committee. Earlier in his career, Miki was an analyst at the Congressional Budget Office and the American Enterprise Institute. He received his PhD in economics from the University of Maryland. Subadra Rajappa is the head of rate strategy at Société Générale. She represented SocGen on the Alternative Reference Rates Committee, the ARRC, or the private group that was convened by the Fed to help coordinate the transition from LIBOR to SOFR. Previously, she was a senior rate strategist at Morgan Stanley, focused on macro themes. She started her career at Salomon Brothers as a quantitative analyst. Subhadra also is an NYU alum, so special congratulations for that. Having obtained her master's in mathematics next door at Courant. Please join me in welcoming our panelists. So Louis will now begin the presentations, followed by Miki and Subhadra. After their brief initial remarks, we'll begin the Q&A session. I think this one has a light as well. So.
Thanks very much, Kim. Thanks everyone for coming. I'm just going to lay out at a very high level my sort of outlook for the US and then make a few comments about interest rates and a few things related to the current political environment and then turn it over to Miki. First of all, last year was sort of a transition year for the US economy. We had been grown about 3% in 2018, 2019. We sort of transitioned to slower growth. A lot of that had to do with fiscal policy. I think that aspect of it was underappreciated. Obviously, we had increased uncertainty around trade policy in particular and weakness abroad, all of which contributed to the economy sort of slowing down to something like 1.5% to 2% zip code. At the moment, the US economy faces a couple of obvious immediate challenges. The shutdown of Boeing's production of the 737 MAX is probably going to take 0.8 off GDP growth in the first quarter by itself. We're obviously dealing with the coronavirus as well. We are expecting a significant slowdown in China, a severe slowdown in China, slowdown in Asia. I'm happy to talk more about that, but it's one of those things where things are going to be bad for a while, but we think that growth will come back relatively strongly after we could get past the worst of it. That sort of gives you a sort of an environment where a weak first half, stronger second half is generally kind of how we see things. We think inflation's going to remain kind of in the zip code of where it's been. sort of struggling to get back towards 2%. Obviously, with that weak growth in the first half, that's going to be more of a challenge. There are some upside risks to the outlook that we see. I would note the fact that consumer fundamentals remain very strong. Certainly one of the ways you could get a more positive outcome is if consumers just decide that they can lower their savings rate, which given how high it is would not be crazy. So strong consumer fundamentals, I think, provide one source of upside risk. Another one is just the fact that interest rates are as low as they are. We obviously, part of what happened last year was a sort of further ratcheting down of interest rates. We're starting to see stronger activity in housing and whatnot, which is one of the places you would expect it. So I think that is another aspect that sort of creates some upside risk. Obviously, at the end of what has been a very long expansion already, you start to wonder about financial risks. If I had to pick one, I would focus on corporate non-financial debt. It's the most obvious source of sort of risk for the economy overall, but I think it's easy to overstate how big a risk it is. Frankly, the very low level of interest rates themselves sort of mitigates the degree to which a higher level of debt is a problem for the corporate sector. If you actually look at the distribution of corporate debt, it's more evenly distributed than it's been in the past. An awful lot of the accumulation of corporate debt was actually concentrated in firms that started out with relatively low leverage. I think that's something which limits the degree to which we should see that as a problem. The Fed is on hold at this point, frankly, probably through the election. I think the bar for raising interest rates is certainly very, very high at this point. I think you'd have to see a significant and persistent rise in inflation, which is just very hard to imagine, to get an increase in interest rates. There's obviously questions about how bad the downdrafts are to get you a cut. We don't have that in our outlook, but I'm happy to talk more about that. But what I want to spend a little more time talking about is where interest rates are and how to think about what they're telling us. So what I'm showing in this chart, this is pretty simple. The red line is just the Fed funds rate, so a measure of short rates. The blue line on this chart is just 10-year Treasury yields. And then this gray line is a measure of nominal potential growth. The gray vertical shading areas are recessions. And so the point is, obviously, one of the things that we see over cycles is in a recession, short rates tend to fall. You get a steeply sloped yield curve. What happens in recoveries is short rates tend to rise up towards long rates. And you see these periods where short rates and long rates converge. It tends to happen before a recession starts. But in fact, the length of time between that convergence and when you get to a recession varies. And so the simple notion that the steepening of the yield curve necessarily means a recession coming, I would push back pretty strongly against that. But the other thing to note about these periods when you see this convergence of short rates and long rates is that tends to happen at a level of interest rates that is more or less the same as potential growth. Now, if you look at where we are right now, we've had a convergence of short rates and long rates, but at a level that is much, much lower than potential growth. And in some sense, it's that fact that I want to just talk a little bit about how to think about that. So the first question is, well, why is that? And I'm not going to go into this, but there's been this long discussion over secular stagnation that focuses on the fact that there are reasons, structural reasons why investment is low, there's structural reasons why savings is high. The economy seems to need a lower rate of interest to sort of keep on track. That's the whole debate about neutral rates. There are other things going on as well, like the fact that the correlation between stock and bond prices is now negative. What that means in very broad terms is your two primary asset classes are actually hedges for each other. And that means that risk premium in general can be lower. But my basic view is that those structural factors that have gotten us here are likely to persist. And so when I think about it and I think about the economy going forward, I think that basic situation of interest rates being lower than potential growth is likely to persist. Now, what are some of the other implications of that? Well, there's an obvious one, which is how much capacity does monetary policy have to respond to a recession? You'll note in these previous cases, short rates fell a lot, like 5 percentage points, even in what was relatively mild recessions. The recessions in the early 1990s and the early 2000s, those were mild recessions, and you still got these very large declines in short rates. But if you actually even look at the decline in long rates, you're talking about 200 to 300 basis point declines in long rates over these cycles. We've got 10-year Treasury yields at sort of 165 as we speak, right? And so there's a fundamental question of how much work can interest rates really do in the next recession. So there's a whole set of questions and there's whole debate, and Ben Bernanke gave his AEA presidential address in January on this subject of like, how much can monetary policy do? I'm not going to sort of dive into that, but that's obviously a question. Now, the other thing that's sort of interesting about that gap is anybody who's done any work on fiscal sustainability knows that one of the most important fundamental things in fiscal sustainability is the difference between the rate of growth, the nominal rate of growth, and the level of the interest rates. This is the so-called G versus R ratio. Now, it turns out that the AA presidential address, not this year, but last year, was given by Olivier Blanchard, who talked about this fact that if interest rates are a lot lower than growth, that gives you more fiscal capacity. So one of the questions that I think people need to think about is in this environment is not only is monetary policy constrained, but fiscal policy has more space. And I would argue we're in an election year. One of the things people should be thinking about is what does that mean for what we can do? Now, I'm gonna not talk about financial stability. Dick will no doubt ask. We can talk about that later. Let me stick to sort of fiscal policy and thinking about if we're gonna think about what's possible in fiscal policy, I think it's worth thinking about that a little bit. What I'm showing you just here is federal spending as a share of GDP going back to basically the 1890s. So what broad things would I take away from this chart? First of all is, like, there are two pretty big shocks. This is World War I, this is World War II, this is the Great Depression, this is the Korean War. That's actually what we did in the financial crisis. Like, one of the things people have noted is when we talked about this being a big fiscal policy, when you look at it in the context of this chart, it's kind of like, well, not really. And so as you're thinking about big questions like climate change or healthcare, and thinking about what's possible in a world where interest rates are relatively low relative to growth, it's worth thinking about these backdrops. Now, of course, what I'm not showing you is where is debt in all these things. So just to make the point, at the beginning of World War II, our debt to GDP ratio was about 30%. We took it from 30% to 115% in a matter of about 3 years. Now, the 1950s turns out were another period when growth was above interest rates. And so the way, in some sense, the United States dealt with this incredible fiscal shock of World War II was we kind of lucked into a period when we had that positive situation where growth was above interest rates. And we used that positive situation to, in some sense, deal with the fiscal consequences of World War II. Now, I'm not going to show it to you, but if you look at where we are right now, our debt to GDP ratio is around 90, depends on which measure you use and which you're looking at, but you look at the projections, they're going up very rapidly. We are currently running a deficit of something like 5% of GDP at the end of a long cycle. So while on the one hand, it looks like a very attractive time to do it, you do have to think about circumstances. Now, the last thing I want to focus on is governance. So given what's going on in Washington today, and given what happened in Washington last night, I can't not talk about this. This is something about partisanship. So there's some very good political science research that takes votes in Congress and you can essentially put individual congressmen on an ideological scale. And what I'm showing you is data that comes from that kind of work. So you think of it as you take every member of Congress, you look at how they vote, and you can statistically put them on an ideological scale. In this case, a low number sort of means to the left, a high number sort of means to the right. And what I'm showing you is various measures of where the Democrats and Republicans were at different points in time. So again, this basically starts in 1870. This blue line here is the median for Democratic House members. This blue dashed line is the 90th percentile of House members who are Democrats. The red line is the median Republican, and the red dashed line is the 10th percentile. So one of the points I would make is, obviously we're living in a time when there's this extreme degree of partisanship. One simple question to ask yourself is, how unusual is that? It feels very unusual. If you in fact look historically, it's not that unusual. In fact, you might make the argument it's more the norm than it is the exception. In some sense, this period around sort of World War II was the period, frankly, when there was seems more anomalous. Now, I look at that and I kind of look back at what it was like here and go, well, maybe it's not so bad, we've survived that before. But if I go back to this previous chart, when we had this level of partisanship in the past, the federal government was spending something like 2 or 3% of GDP. We're now spending 20% of GDP. We simply ask the government to do an awful lot more now than we used to. And the fundamental question I would ask is, how big a problem is that partisanship in a world where we're asking the government to spend 20% of GDP? And to be perfectly frank, governance doesn't feel like it's working very well. I'm going to stop there.
Let's see, how do I end this?
They're going to advance to the next. There you go.
So I'll take more of a focus on globally to start. Global trade volumes have been very soft since the financial crisis, and they slowed a lot in the 2015-16 period. Now they're declining. And if you look at the right side of this chart, you see what trade economists call the trade elasticity of income. And in prior decades, trade grew multiples faster than global output, and now it's a touch below that. Now, the decline in the last year and a half, I mean, this has generated a global industrial slump. You have global industrial production declining in most advanced nations, and capital spending's also weak. And in many nations, you have healthy gains in consumption that are offsetting this. The US is much better situated than other nations in this regard. Now, if we consider the decline and the weakness in global trade and the decline in industrial production, this is, in the last year and a half, it's been emanating from China's material economic slowdown. I don't have a lot of time to go into this, but China's potential growth is decelerating, and its actual growth is decidedly below what the official government statistics say they are. Now, if you break that down, China domestic demand is weak. Some of its consumption has slowed a fair amount. And then on the export side, now keep in mind, China for the last 20 years has been the driver of global growth and global trade. And its exports and imports, which had been growing double digit, are now flat. Okay, and so it's really interesting to look at international flows. China has become the global hub for production. They import a lot of materials and commodities and capital goods and durable goods. They produce a lot of stuff and then they export it out. And so their exports and imports have flattened. And there's no question but that in the last year and a half, the US tariffs and trade policy uncertainties, they've accentuated China's weakness in global trade. But the slowdown's been occurring for years. Okay, so there's no question, but and it's very interesting. A lot of the most recent empirical work shows that it's a trade policy uncertainty is having a bigger negative impact than the tariffs per se. Now, when we look at this flattening global trade volumes relative to global output, if you go back and review the research literature on this, what you find is all of the factors that drove the robust trade in the 90s and the 2000s, they're all negative now. And so you could list them off. China's fundamental slowdown, the fact that advanced economies, whether you look at US or Japan or core Europe, their capital spendings declined as a share of GDP, the increased reliance on services as a share of GDP. Note that Chinese leaders 3 years ago said, we want to rely more on domestic demand and services. There are now higher barriers, not just to trade, but to immigration. And unfortunately, it's not just the US. And then on top of that, multinational companies are reining in a lot of their global supply chains. And this started a couple of years ago, and it points to if things pick up in trade, it's only going to be a modest pickup. Now, regarding China, the way I think of this virus epidemic, it operates to me like a negative economic supply shock. So you have a decline in aggregate demand and a decline in aggregate supply. People save more. And I'd like to make an important point about China. There's a large portion of the middle and upper middle class that doesn't trust the government. So the fact that the government has lost credibility may accentuate this. And what you see is China's consumers, they're spending more on things they think are necessary and less on things that they think are discretionary, like autos. I mean, I don't think you see many auto sales this week in China. Same for not just hospitality and leisure, but things like consumer electronics. Now, if you just take autos, auto sales in China have fallen a lot from the peak 2 years ago because of tightening loan covenants and the like. This accentuates that. So you have weakness in demand, and that's going to reduce China's imports. On the production side, if people don't go to work, production is tied up, and here I'd make 2 points. Firstly, if the true base of China's growth now is not 6%, like the government would lead you to believe, but a more realistic something that's less than half of that, it's serious there. We don't know how long it's going to last. And the critical question that we don't know is how will this distort, harm global supply chains? We just don't know. All we have at this point is anecdotal evidence, but there's no data. Within a month, we'll start seeing trade data of South Korea, Japan, Australia, and the like. If we look at prices of global industrial commodities and oil, the market's starting to expect there's going to be a sharp, sustained slowdown. I would say one of the lasting impacts on this is not just this virus per se and the lack of credibility, but if you put it into the context of what's going on in Hong Kong and the like, I think one of the long-term negatives for China is global companies are going to be reassessing their global supply chains. Okay? Now, I mentioned that, what else do I have here? So you see, China's manufacturing PMI, it's a survey. It leads world industrial production by about 3 months. Okay, now the US is better positioned with, you could say sound fundamentals, but we all know what's happening with the debt and the allocation of resources and some of the governance issues that Lou mentioned and the dysfunctionality of Washington. But the fundamentals underlying the U.S. consumer are very sound. Okay, employment gains, rises in real wages, in part due to productivity gains. This is raising real disposable incomes, wealth, high confidence, housing is strong. These look like they should continue to be strong. The weakness, industrial production and capital spending, and the way I think about capital spending being so weak here, despite the Fed's efforts to lower the real cost of capital and stimulate capital spending, is the positives that boosted business confidence and led to, in part to some of the stronger capital spending due to the deregulatory environment, plus some of the corporate tax reforms. As far as I can tell, those are being just offset by tariffs and the uncertainties. And now we have to see what happens, post this U.S.-China agreement, and the jury's out on that. Now, as for, by the way, this employment to population ratio of prime-aged workers, this shows that the supply of labor is much more elastic than standard models presume, and you see wages are rising. Now, I would say the economy looks solid, and I would emphasize that, I'm not too far from consensus on growth, but I would emphasize that the probability of recession is very low. And here's how I go about it. Lou mentioned the funds rate with respect and inflation with respect to nominal GDP. I'll echo that and say, yes, the yield curve's inverted, but there are other ways to look at the economy. So if you look at the real economy, there are no apparent imbalances. On the financial side, with interest rates so low, I think that'll mute. It will continue to mute the financial imbalances. And here I'd like to show you real wages, which don't get as much attention as they should. Now, what this chart shows is it shows year-over-year real wages, okay, in the 18 months prior to every recent recession. I put a dotted black line where we are now. It's a 3-month moving average year over year. I didn't know whether to put it at a point or just, so I put it as a dot across. And what you see is, with very, very few exceptions, economies continue to expand. They do not go into recessions when you have rising real wages. And there's a reason for that. Real wages increased purchasing power. This happens to reflect productivity gains. I actually took some of these estimates of the probability of recession. I could do a probit regression analysis that usually has regresses the probability of recession and puts the yield spread on the right-hand side. I tried it with real wages, and it doesn't provide as good a fit because it provides some type 1 errors, some false positives in the middle stage. But then what I did is I just got a typical, like a Stock-Watson probit analysis, and I added to the yield curve. You just add the real funds rate, and then you add real wages, and the probability of recession is extraordinarily low. Now, I'd like to broaden that to the following. Okay, what I did is I went back and I looked at what happened at the end of all previous recessions. And I looked at oil prices, inflation, the federal funds rate, and real wages. And the situation we have now is just like almost the opposite of what has happened before every prior recession. Real wages are rising. Inflation is low. Who can disagree with Lou about what the Fed's going to do? I mean, they're on hold now, and the bar to raise rates is just ridiculously high. Inflation isn't the problem unless nominal GDP accelerates significantly. So the probability is a recession is low. Now, why is that important? Well, because people like expansions. But if any of you are interested in the stock market, I wrote a paper in the spring of 2018, and I asked the following question. What happens to the S&P 500 if corporate profits fall and the economy keeps growing? And what it showed is, and there's every expansion, there's been a mid-cycle peak, whether you look at NIPA profits or S&P profits. Guess what? The stock market kept on going up nearly as long as the expansion did, even if profits fell. Hey, that's where we are now. Now, don't ask me why. That's a toughie. That's just an empirical finding. Now, on the Fed, what I'd like to emphasize is it's not just the Fed that has what I think is easy monetary policy with excess balances and very low interest rates. The ECB with its negative rates and QE. It is the BOJ with its persistent QE and negative rates. And I like to ask a few questions about this, and that is, what would have happened if all the Fed's QE and negative rates had actually worked to stimulate the economy as the Fed's model had predicted it would? And what I want to emphasize here is whether you're looking at the Fed or the ECB, one of the most interesting areas to dig into is why haven't the channels of monetary policy worked as they traditionally did before the financial crisis? And then I think there are real flaws with forward guidance. I could just mention one thing. You know, the Fed, through its forward guidance, perceives and builds into its models that, yes, it can influence financial market expectations, but through its forward guidance, can it really influence the expectations of non-financial companies? And so I think there's some real issues here, and I would emphasize that when we look around the world and see these really, really low rates, and particularly low bond yields, which are pushing up asset prices and contributing to wealth inequality, and they're driven by, in part, by the central bank's forward guidance. Are the central banks trying to do too much and trying to push monetary policy beyond their natural scope? So I'll stop there.
Yeah. I'll try to keep this short and sweet. So I'm not an economist, so I'm not going to argue with Miki or Lou. But you know, from my perch as a rate strategist, I feel like the U.S. economy is at crossroads. There are several key risks to the economy. Just from your questions that we've received already, it's trade, Brexit, U.S. elections, you name it. But the way we look at the world, we feel like the risks are sort of tilted towards more to the downside, especially for yields. My feeling in this current environment is that the risks to yields are somewhat asymmetric, i.e. that the market is going to react more by rallying a lot more if the data is weak, as opposed to selling off if the data is actually positive. So just quickly, these are forecasts from our economists. Clearly, by looking at the GDP forecasts for the second and third quarter, our economists are calling for a recession. So it's exactly the opposite of what Miki was talking about. If you look at some of the data that's been coming in, business investment's been falling earlier and faster than in previous cycles. Trade uncertainty is probably contributing to it. Boeing, GM strikes are also sort of contributing factors. The key risk is that even if you look at the fourth quarter data, broadly speaking, we had a 2.1% GDP for the fourth quarter. But the household spending sort of weakened a little bit. Business spending is continuing to fall. Imports of consumer goods also fell partly because of tariffs, but these tend to be sort of the leading indicators of a decline in domestic demand, and that's ultimately my concern is that the US economy is sort of running on one engine, and it's a big engine, it's the consumer. So anytime you see any sort of a pullback from the consumer, I think that that's going to quickly translate to a slowdown in the economy and economic conditions. Really where I see the trouble spots are in CapEx spending. CapEx spending has declined quite meaningfully. As Miki had pointed out, after the tax cuts in 2017, I would argue that a lot of the extra cash that corporations had was sort of put to work either in equity buybacks or executive compensation. Very little of that actually went into CapEx spending and business investment. CEO confidence, another metric that we track, has been quite low. I would say that third quarter was the lowest CEO confidence level in the past decade, and in the fourth quarter it rebounded a little bit, but it's still below 50, which is a magical number for a positive confidence indicator. The other trouble spot is ISM manufacturing. I mean, the typical pushback I get for when I show this chart is the US economy is not that reliant on manufacturing. But if you look at 10-year Treasury yields, the chart on the top there's a very strong correlation between 10-year Treasury yield changes and the ISM. So the rates market, broadly speaking, seems to be trading much more in line with weakness in ISM than positive sentiment in equities. So to sort of counter what Lou was talking about earlier, I feel like the markets are correlated. I feel like the equity markets and bond markets are correlated. Everything seems to be rallying because the Fed is keeping policy somewhat easy. So really, I do see Miki's point on the recession, but really the reason for why our economists are calling for a recession is the fact that we think that corporate profit margins are declining and are going to continue to come under pressure. If you look at the rise in unit labor costs as well as the decline in productivity, that I think ultimately is what leads us to a recession. And in this cycle, we would argue that that corporate profit margins peaked in 2014, have been sort of steadily declining. And as we progress through the cycle, if we do see corporate profit margins continue to come under pressure, at some point you're going to see that corporations are going to scale back on investment and hiring. And if there's any sort of a slowdown in the job market, that's ultimately when you're going to see a retrenchment from the consumer. And that's really what is the concern that's driving some of our forecasts and our views. I agree with both Lou and Miki that I feel like monetary policy is actually reaching its limits. So if you look at the chart on the top right here, I'm kind of scratching my head as a market practitioner on when Ben Bernanke said that there's 5% percentage points of room for, and the Fed has more room to sort of ease monetary policy. Term premium this time around is negative and at historic lows. So if the Fed does bring interest rates back to the zero lower bound and starts either using forward guidance or QE, my concern is that they're not going to be able to deliver the same level of easing they delivered during QE when they could compress term premium quite meaningfully. At this point, term premium, in my opinion, are extraordinarily tight, and it's going to be very hard for the Fed to deliver monetary policy. The other concern for me is the survey-based measures of inflation. If you look at the Michigan 5 to 10-year survey-based measures of inflation, inflation expectations have declined quite meaningfully. And the 5-year forward, 5-year break-even, which is a metric that the Fed tracks very closely, seems to be tracking the survey-based measures of inflation. And that, I would argue, ultimately is the Fed's concern, is that they are concerned that they're going to lose control over inflation expectations. So they want to act preemptively by cutting rates more aggressively in this cycle. And my concern is that they're not going to have nearly as much room to cut rates. The other concern to me is inflation expectations globally. If you look at 5-year forward, 5-year break-evens, in Europe, it's at historically low levels. And so you have this sort of gravitational pull of inflation expectations declining quite dramatically overseas. And that's keeping inflation expectations in the US low. Even though if you look at core CPI for the past year, it's been above 2%. Yes, core PCE has been tracking well below 2%, but core CPI has been above 2%, but inflation expectations are low and declining. So in this context, broadly speaking, our 10-year Treasury forecasts are at 120, the lowest 10-year Treasury forecasts on the street. And again, my concern is that the risks to the economy are sort of asymmetrically skewed to the downside. So if there's any sort of, the price action, I would say, in the last 3 weeks is sort of telling, right? I mean, we had the coronavirus scare, and we saw 10-year Treasury yields decline out to, all the way down to 150. So it doesn't take a lot to sort of move the markets towards lower yields. The other sort of point I'm going to make is the counterfactual, which is I really don't see any clear catalyst for a sustained rise in yields above 2%. So, yes, I don't profess to the idea that business cycles die of old age, but 10 years into this business cycle, my concern is that if there's any continued weakness in manufacturing or weakness in the job market, then the reaction in the bond markets is going to be for a further decline in yields. Global inflation, like I mentioned, is relatively muted, and monetary policy is, it's not just the U.S. Broadly speaking, monetary policy across the globe is biased towards more easing than tightening. So in this environment, I think it's going to be very, very hard for Treasury yields to rise meaningfully. And the other metric that I track very closely is the demand for global bonds. And the demand for global bonds is extraordinarily high in an environment where you have 12, 13, 14 trillion of negative yielding assets. So we track the balance of payments coming out of Japan, and consistently you tend to see demand for U.S. assets, whether it be corporate bonds or treasuries, given the fact that yields in the U.S. are a lot more attractive than global bond yields. So in this context, I just don't see a clear path towards higher yields from here. So with that, I think I stuck to my 7-minute target, I think.
Thank you, Subhadra.
Oops.
So thank you all. So you can now see above me that if you'd like to pose a question, all you have to do is go to slido.com, slido.com on your smartphone, enter 4444 in the tab for joining the conversation, and you have to submit your full name. We only accept questions where you provide your full name, no anonymous questions. But please do submit, and please do vote on the other questions. That's going to influence what we talk about for the next 45 minutes. So with that brief advertisement, let me begin with the question that's received the most attention from my colleague, Professor Carpenter. What is your perspective on the recent Phase 1 trade agreement between China and the United States? Who would like to jump in first? Miki, go right ahead.
I think it's, despite not liking Trump's approach to looking at bilateral trade deficits and this and that, I think it's a positive. When we look at the broader context, here you have China and the US, the two biggest superpowers in the world in every way, that are 180-degree opposites in every way. And they've come to an agreement even though they know it's best for their trade and their economies. And if you look at global flows, China desperately needs to keep its channels of trade open, and so does the US. On a more narrow perspective, I actually read the 91 single pages of paper in this document, and there was, I don't like the way it focused on, attaining certain trade goals within the next 2 years. It should be a long-term document. I wish it would have been a multilateral agreement, but it wasn't. But there was some very interesting detail within it that revealed the amount of debate that went on between the experts from both countries, and I think it's a positive. And in the near term, I'd love to see global trade uncertainties come down. I'm less concerned, I'm less focused on whether the agreement is met over the next couple of years. I'm most interested in seeing the follow-up and what it means for things like opening up China's capital markets to the exchange of ideas. And so I liked all the detail in it, even though, once again, I would have liked to have seen a multilateral agreement.
Louis?
I'm probably a little less optimistic. Look, what I see is the U.S. and China are on very different paths, and I see more things pulling them apart than pulling them back together. And so there's the fact that China has maintained a predominant position for the government and the economy overall. To be perfectly frank, the rules of the game for trade and international investment that were put in place at the end of World War II, and we've kind of, some of us have spent time trying to promote, never really anticipated having a major part of the system that was just governed in a very different way. So that's one problem. The interaction between information technology and national security in the world we live in now creates some very specific problems in that very important sector. In the last 30 years, we've kind of gotten used to there being one kind of global IT universe, and I think we're headed for two. I think those gaps are very hard to bridge, and frankly, the Phase 1 deal doesn't really address that. Thirdly, there's just a fundamental difference between how the US on the one hand and China on the other sees issues around, I will call it human rights. I don't want to take a position necessarily, but if you just see the way the issue of Hong Kong and the Uyghurs have played out in the US Congress over the last 6 months, this is a problem that's not going away. Those are all reasons why the interactions between China and the United States going forward, I think, are going to be much less than they've been in the past. And I think we are only at the very beginning stages of figuring out how to manage that problem. Look, it's in both sides' interest to try and figure out how you can maximize the positive interaction within those constraints. And I see the policy challenge going forward is very much, how do you do that? How do you find the best way of maintaining as much of the benefits of interaction as you can, while accepting the fact that they are just some very big differences that are not going to be able to be bridged. And I think we're only at the very early stages of figuring that out.
But I would add, there's
I just want to give Subhadra a chance if she wants to jump in.
No, I mean, from my perspective, I feel like, from a market reaction perspective, I feel like the deal wasn't necessarily impactful. It probably is a 0.1%, 0.2% impact on US GDP. For the markets, broadly speaking, I think the best way to sort of phrase Phase 1 is it's a ceasefire. It's a positive on business sentiment. It's a positive on generally, broadly speaking, gives some certainty on the outlook. But I can't say that anything meaningfully was accomplished from a growth perspective. I think it's more the bigger picture items that they were trying to tackle. So I think there's a lot more work to be done. I think Phase 1 is just literally the beginning. I feel like they have a lot of wood to chop, and it has to come in Phase 2.
I was just going to say, superpowers, whether it's the Soviet Union and the US or the US and China, what do? They fight with each other and they squabble. But I think this is a nice step, and I would note one of the chapters in the 91-page document was about setting up a very, very high-level joint supervision and resolution authority of this committee. And let's see if it works. I understand a lot of people, like from Europe, feel left out, and they say, oh, this supersedes the WTO. Yes, that's a problem. But I actually think this is going to work out, and it opens up some really important channels of discussion and oversight that will be positive.
Let me just follow up with one question that might focus the discussion. There's an old literature in economics and trade about whether a particular action is trade expanding or trade diverting. How would you characterize this this agreement on that basis?
Trade diverting.
And the reason?
The goals that China agreed to in terms of its additional imports, to be quite frank, we've looked at and don't think are terribly plausible. If you just simply do the math, the commitments they made for increased purchases of goods from the United States this year, it represents 90% of what we would have projected for the total increase of Chinese imports of goods. Now, there are basically three possibilities. One possibility is China actually increases its imports by that amount. I can't rule it out, but it raises fundamental questions of balance of payments, capital flows. There are lots of questions you would ask if you wrote down a change in China's balance of payments that reflected that large an increase in imports. That's option one. Option two, they meet the objective to the U.S., but do so by importing less from other countries. That's the trade diversion. There are obviously fewer soybeans from Brazil, less LNG from Indonesia and Australia, less cars from Europe. You could certainly see that happening, but that's your classic trade diversion. And of course, the third option is they simply don't meet the objectives. If I could just quickly respond to Miki's comment earlier, I'd say two things. One is the things where real progress in some sense were made in the phase one agreement were about intellectual property. It was both provision of protection for intellectual property and technology transfer. Those have been longstanding issues, and to some extent I would agree that that's progress. The point I would make, though, is that in what's happening in China's development is they're going from being very far from the technological frontier to being at the technological frontier, and their objective is to be the ones advancing that frontier. If you think about your incentives in terms of how you think about intellectual property, it makes all the sense in the world that China would want to go from having a weak intellectual property regime to having a strong intellectual property regime. I'm not mean this to be critical on the Chinese side. I'm merely saying it makes perfect sense from their perspective to go down that road. And I don't see that side of the agreement as dealing with the issues which I see as being the problematic issues going forward. In terms of the enforcement mechanism that was set up, forgive me, but it sounds an awful lot like the strategic economic dialogue that was set up under Paulson. Like, it's not like there haven't been regular, deep consultations between the US and China going back. And to be perfectly frank, this one doesn't look that much different than the ones that previous administrations have run. Yes, it has a slightly different framework, and Lighthizer is a great guy, and it makes sense to have him leading it, but the notion, I would just push back on the notion that that is somehow fundamentally different from what has structurally been in place in the past.
Miki, did you want to follow up?
Sure. I think it's going to expand trade. I agree with Lou. There is slippage, and they'll know that. Let's look at this. Let's look what they're doing in finance. China's always had a very closed financial system that's driven by its SOE banks. Now this agreement allows any U.S. bank to open a branch in China and sell in it not only basic banking and depository services and CDs, but also allows it to sell stocks and asset management and insurance. Of course, we don't know how much capital requirements there are and the like, but I see this as very nice. And so my read is China's and the US are the world's biggest traders. If you kind of do a game theoretic, not just thinking about China, but thinking about Germany and every other country and who they need and who they don't need, China and the US really need each other. And I think they made this agreement because they knew they had to, even though they're polar opposites in so many ways. So let's see what happens. But like I said, I'm less concerned about whether they meet the numbers in the next year or 2 years. I wish they hadn't come up with those numbers. I wish they had been longer-term numbers. But I think we're all going to be pleasantly surprised. And keep in mind, also from China's point of view, we all use this word intellectual property. There's, it's not all bad. It's not all illegal stealing of intellectual property. The U.S. relies on China, and China relies on the U.S. for exchanging ideas. And China wants to keep those channels open, and so there's quid pro quos along the way. And I think you're going to see progress over time.
And I want to be clear.
But they're going to disagree.
And look, I want to be clear that it's certainly better that we have the deal than we not have the deal. And certainly relative to where we were last summer with the prospect of further tariff increases, we are much better off with the deal than not. And you're a little bit glass half full. I'm more focused on, I am just struck by relative to where I thought this relationship was 3 or 4 years ago. We are in a much more difficult place, and I see a very long road ahead to getting to something that I would think of as being an equilibrium, if I may put it that way.
Subhadra, anything else?
No, my concerns are around enforcement. My concerns are around what the longer-term impact is going to be of tariffs, because I think both parties, regardless of Republicans or Democrats, are going to remain hawkish on China. So if you do get a Democratic president, I don't see a pullback in tariffs. So I think that there's probably a better solution out there, and I'm probably not the expert on this topic to comment on that.
Okay. So I'm going to ask you guys to keep the answers short so we can get through a lot of these, at least a few of them anyway. The next one you've all addressed a little bit, so let's just be more specific. This is the question of how the coronavirus is affecting the outlook China globally and in the U.S. So maybe start at the far end. Subhadra, how do you want to go?
I see this as very different than the SARS pandemic or the SARS incident that happened back in 2003, in the sense that I think, like Miki pointed out, I think we don't have a lot of information. So from the market reaction, at least thus far in the last couple of days, has been one of problem solved. I feel like there could be a lot more. As time goes by, we'll have to sort of reassess what the impact is going to be. But to me, I feel like this could be a bigger issue than meets the eye.
Miki or Lou?
Once again, I think it's a negative supply shock. When we see pictures of a 10-lane wide boulevard in Beijing, and there's one person walking across it and no cars, and you talk to friends who live in Shanghai, and you say, what are you doing? And they say, well, I'm holed up in my apartment. Well, if people can't go to work, you can't have the factories move. And then the point is, we don't know how it's going to affect global supply chains. We just don't know, and we're not going to know for a while. And it's hard to add up the anecdotal evidence, but it seems negative. And one point about, one way this is different than SARS is China is the hub of global production. It's the biggest trader in the world. And so we gather anecdotal evidence about what companies are saying, we had to stop production or we need that component. And we just have to add it up and kind of go along and figure it out. And it's too bad. But I say it's negative with risk to the downside. But when we think about, it's not going to hit everybody evenly. It hits China the hardest, and once again, the lack of credibility of the government is going to have a lasting impact on global supply chains. It hits some countries like Australia. Its exports to China alone are 18% of GDP, and it's reeling. Germany stands out like a sore thumb. Its exports to China are 7.25% of GDP, and that's mostly autos and parts and components. And auto sales are falling there, and then you have to think about the feedback effects. And you know, if Germany's labor laws don't allow people to lay people off, then their productivity falls. So you have to think about all the secondary and tertiary feedbacks, and it seems negative, and we all wish we knew more about what was going on.
Yeah, we really don't know, but what we do know is pretty significant. Look, Chinese GDP fell by 2 percentage points in Q3 of 2003 when SARS hit. I think all the evidence suggests that this is going to be more disruptive than that was. I would stress the fact that at this point, what we're fundamentally dealing with is a public health response, which is significantly disruptive to normal economic activity. That is a very unusual thing. There are very few things that can move Chinese GDP by 3 percentage points in 1 quarter. But the good news is, I think it's very likely that you could, once you're on the other side of it, those things will be eased and activity will come back very quickly. So this is a big thing. It is going to be a big initial downdraft. You will see big movement in the numbers, but it is likely to come back relatively quickly. And I think partly what's hard for those of us who aren't kind of in the middle of it is thinking about how do you deal with something that's like that but comes back. And I think that's what we're dealing with.
Okay. This got mentioned, but very briefly. Do you have predictions for the effects of Brexit, either economically or in market terms? Subhadra?
Yeah, no, we do, and I think I think Brexit is a decent risk for this year. I think UK is very ambitious in thinking that they can negotiate a deal with the Eurozone by the end of the year. I think Johnson is very adamant to get that done, and that's a very, very aggressive timeline. So my concern is that if they don't apply for an extension in the middle of June, which is a deadline, and they're not able to negotiate a deal by November, then it's basically going to be a no-deal Brexit.
Miki?
There's no question there's some very thorny issues surrounding Scotland and Ireland and passporting, but I think there are very few concerns in my mind about trade flows. And it comes from the following. The UK and Europe traded for hundreds of years before they became a semi-union. Keep in mind, during the union, the UK always had 1 foot in and 1 foot out with its own foreign policy and own military and own central bank and own currency. And they'll continue trading. And once again, if you look at trade flows, let me just give you an example. If you look at, for example, trade flows between Germany and the UK, German politicians would love to punish the UK now for what it's done. German industrialists who have some say in the matter will say, we can't punish them. That's our 3rd biggest export market, and we're already reeling from what's going on in China. And so trade is going to continue to unfold. And I would say the UK will do just fine. And I think March 10th, you're going to see a rollout of a big fiscal package, and a lot of it's going to be for infrastructure spending outside of London. And I think the pound will appreciate. And then, 6 months and a year from now, people will say, gee, the world's still going on. Britain's still here and Europe's still here. And there were a lot of negative disruptions, but things are kind of okay.
Okay. Actually, no economic forum these days can go without asking this question. How does climate change affect your outlook on the global economy? Lou, why don't you pick up?
It's just something I'm still trying to sort of think through. I would note the fact that we've had some positive data surprises this week that we think are related to the fact that the weather was unusually mild in the month of January. And so on the one hand, I'm tempted to say it's going to create some inherent variance in the statistics short term. Obviously, over a somewhat longer horizon, a lot depends on what the response is. As I sort of think about this, it seems to me that some sort of large carbon tax seems almost inevitable. When I say inevitable, I mean over the relevant set of political cycles, which certainly may not mean the next 4 years in the United States, but that's got to be part of it. I think there's also probably got to be a significant burst of public investment in really two directions. One is coming up, facilitating the development of alternatives, as well as trying to change the energy infrastructure in ways that are supportive of whatever the alternatives are. I think that means that is part of the sort of different attitude around fiscal policy. And so I think if you're thinking about the outlook for Europe and thinking about fiscal constraints, this is the obvious kind of political way out of that. I'm not sure I'm far enough along in my own thinking to have anything more coherent to say than that, so I will stop there.
Anybody want to add something?
Lou mentioned a carbon tax, and of course, that would reduce the demand for carbon. But you know, as we're speaking, there's a huge amount of capital and expertise pouring into the field to develop new technologies. And you know, once again, despite all of President Trump's crazy tweets on this issue, the U.S. reliance on wind and solar has skyrocketed. At the same time, its reliance on on coal has fallen significantly, to the point where the U.S.'s reliance on alternatives, some alternatives, will exceed Europe's next year. So there's a lot going on behind the scenes. And so Lou talks about suppressing demand, and I'm in favor of that. And I would also say, you know, we very well could be surprised by some technological innovations that you know, have a long-run impact. It's not going to affect anything in the near term.
So yeah, let me pick up on that a little bit. One of the things that has to happen is there's got to be a bunch of changes in behavior. I mean, unless we think that we're just going to somehow solve this entirely by coming up with alternative sources of energy that somehow magically don't produce carbon, there's going to have to be a bunch of changes in behavior. And one of the fundamental questions is, what do you need to have that happen? I start with carbon taxes because I'm an economist, and that's kind of naturally how you think about it. Some of the most interesting research I've seen recently is sort of trying to make the argument that there may be a behavioral response to this, that you can actually get people to change their behavior without changing the prices. That's interesting. I'm not sure I'm kind of there yet, but if to the extent that a big part of this has to be we all are going to live our lives differently because of this, it seems to me a carbon tax has got to be part of it. The fundamental question of what can you do to try and facilitate the fundamental innovation that could ease the constraint. There's obviously a trade-off between how much we all have to change our lives and fundamental innovation that can sort of solve the problem. Obviously, the more innovation you have, the better off you are. That's an interesting question, and I tend to think that there's a role for both public investment and public policy in trying to facilitate that. It's unfortunate things like Solyndra kind of got as much attention as they did, and I think undermined what was arguably, I think, an attempt by the Obama administration to kind of move in that direction. But those are challenges. And look, I certainly don't pretend to.
I'm going to move on to the next one
answers.
and pass it first to Subhadra. What do you think about high income tax rates on the rich, and specifically about the potential impact on innovation or entrepreneurship?
I'm not an expert on this topic because I'm not an economist, but clearly there's enough data over the last 3 decades that trickle-down economics does not work. So I don't know if the solution is taxes on the rich.
I feel strongly you should tax the rich after they die, not while they're alive. I mean, so do it for estate tax. I mean, it's. I think it would. I just think that's the right way to go conceptually and ethically.
Okay. No?
Look, I think we, and I include myself in this, have not paid enough attention to income distribution and wealth distribution, and we've kind of gone along without thinking about that as an important social objective, and I think inevitably we're going to move in that direction. I think efficient tax design matters, and so I don't consider myself an expert in this. And so I don't want to sort of come down on exactly what I think the right answer is. But I think we have to move in a direction where we are effectively, in some form or another, taxing the people who sort of win the job lottery. I consider myself somebody who has won the job lottery. I think we need to think hard about how we do it in a way that is least disruptive to overall economic outcomes. So I endorse the premise of the question, if I may, without giving an answer.
Wait, you responded to income taxes, whereas the question was about wealth taxes.
No, it was about income
it's about
tax
income
rates.
tax.
About income taxes?
High income tax
I
rates.
think we have to do both, but
The problem is there's a lot of people that are high income earners who've won the job lottery that are not paying any taxes, right? I mean, things like carried interest and the likes, which are very controversial. There's just not an equal contribution. I mean, I know that I pay taxes. If I make more money since I work for a corporation, I'm still going to continue to pay, the max amount of taxes that I'm supposed to, but because I don't have any loopholes that I can take advantage of. But there's a lot of people that do.
That's a tax efficiency argument. I mean,
The question was, what do you think about the impact, in particular on innovation and entrepreneurship of high income tax rates?
well, but then we were introduced to the loopholes. I mean, if we would actually go back, there was some great research that began in the late 1960s about the tax expenditure budget and the losses in revenues stemming from deductions, credit, exemptions, and the like. And if we would close those, you could actually make the economic system more efficient. You would allocate resources more in the right way, and you generate revenues, and you would reduce some of these egregious violations of what we think about as income inequality.
There are several questions about an issue that you've all raised. Interest rates are low, so the Fed's monetary space is substantially reduced. What's the role for the Fed going forward? Subhadra, why don't you kick off?
That's a very good question, and I think that it's a struggle for me because if you look at the ECB, I mean they've cut rates into negative territory, which I'm not a big fan of, generally speaking. They're doing a lot of QE. They own about 50% of the debt outstanding. And broadly speaking, my concern is the transmission mechanism between monetary policy and broader utilization rates in the economy is just broken, right? I mean, even back in 2008, or prior to 2008, as soon as the Fed cuts rates, you would see a mortgage refi wave. People would take out home equity loans. There'd be robust consumer spending on the back of that. Yes, in the last, after the last 3 rate cuts last year, you did see a pop in some of the interest rate sensitive sectors of the economy like housing, but not to the extent that you would want to see the impact of monetary policy having on the broader economy. So as we go towards the zero lower bound, my concern is it's going to get more and more difficult for the Fed to really meaningfully move the needle on stimulating the economy, especially on the inflation side.
Jump in where you wish.
Go ahead.
So, I say a couple things. One is, yes, there's no question that kind of where we are and all these things we've talked about, in some sense, reduces the capacity of the Fed to sort of provide stimulus in a downturn. the fact that it's been reduced doesn't mean they shouldn't try. And in fact, I would argue, why not they, the right response is to be more aggressive on the tools that you have that can work. And if you go back and read Bernanke's presidential address, he makes a strong argument that there's still substantial capacity to do it. I personally support his robust defensive QE and its effectiveness. I'm not sure I share his degree of confidence that it's going to work, but let me make one observation. One of the things which I think is really interesting, and you mentioned it over the last year, is in some ways you can interpret the way interest rates have moved over the last year is we got a bit of a whiff of a recession and rates just collapsed. I would actually argue a big part of that was the market anticipating how the Fed would respond in a recession. What the Fed has said they will do in a recession is, number one, move short rates to zero quickly, number two, engage in forward guidance, and number three, engage in QE. All of those things are good for long rates. And in some sense, that very downside flexibility, I would argue, is in fact stabilizing. I think of it as a sign that in fact monetary policy is working, because the market is responding to that in a way that is ultimately stabilizing. So it's a problem. I think we need to be thinking about alternatives, but in some ways, that doesn't, to my mind, mean we should just go, okay, there's nothing the Fed could do, they should just be passive.
I'm a constructive critic of the Fed. I think it's expanded the scope of monetary policy beyond what it's capable of doing. And so once again, if you look at the channels through which monetary policy is supposed to affect, aggregate demand, whether you look at a monetary textbook or you look at what Bernanke said in 2012 when he rolled out QE, a lot of those channels are not working now. And the Fed continues to behave and communicate as if they're working. And I think there's a real problem here because, for example, the very low interest rates and the lower real cost of capital, either by rates coming down or the stock market going up, have not stimulated capital spending as any textbook would tell you or as the Fed's model predicts. The Fed's forward guidance has kept rates low. It's been very successful in pumping up asset prices and encouraging risk-taking, just as Bernanke said it would in 2012, but it hasn't led to an acceleration in nominal GDP. I think there are a lot of problems, and this creates a lot of communications problems. And I think all of us around, whenever anything goes wrong, people say, oh, the Fed should ease more. Oh, the ECB should ease more. And for what purpose if it's not working? Does that just mean do more of it? Okay, so the Fed, people who've worked at the Federal Reserve, and most people there now, their response is, oh, if we hadn't done what we did, things would have been horrible. And I completely agree with them about their responses to the financial crisis. But I don't agree with them with regard to a lot of what they've done since then. And they're very well-intentioned. And the ECB is very well-intentioned. They've got a more difficult task because they're the financial backstop of Europe. And if they hadn't done what they did, the EMU probably wouldn't have stayed together. But I think it's time for the Fed to be a little more circumspect. And they've convinced themselves and convinced financial markets that whenever there's a problem, go to the Fed and they'll ease and then everything will be better. And I don't think it makes things much better. And it does accentuate wealth and income inequalities.
Okay. In the last few months, there was at least several months ago, there was some turbulence in the repo market. And the Fed has expanded the supply of reserves, purchasing Treasury bills in substantial quantities since then. So to what extent is this going to continue? Is there a prospect for this coming to an end? would it help to have a permanent standing repo facility as an alternative to these discretionary interventions? Subhadra, why don't you kick off?
Yeah, so I think that at some point the Fed is going to start pulling back on the repo operations. I think that the level at which, I mean, we know that back in September, reserves were way too low at 1.3 trillion. We found out where the steepest part of the demand curve is for excess reserves. And it's since then, the Fed's pumped in about 200+ billion in excess liquidity. And I think excess reserves need to get to maybe 1.7 trillion-ish. That's kind of where I think you're going to see some longer-term stability. And that's when I think the Fed's going to sort of ease up a little bit on the repo. So we see them continuing to purchase assets. I think I've said this many times in many public forums. I'm just sort of, not a big fan of the standing repo facility per se. I think that the Fed is ultimately becoming the repo market in some respects. So I would prefer that they just sort of organically grow their balance sheet. We know that they have to maintain a large excess reserve regime to avoid volatility in the repo market. Mm-hmm. But I'm not sure that the standing repo facility is the answer. I think that that's really the internal debate that the Fed is having right now is, what should this facility look like? Who the participants of the facility should be? At what rate the facility should come at? It can't be too close to IOER because that's going to they're going to become the repo market. It can't be too much higher than where IOER is, in which case it's going to stigmatize some of the market participants from partaking in the facility. So, and that's why, the first paper that came out was March of last year from the St. Louis Fed. The Fed's had a lot of time to come up with sort of a roadmap for what this facility should look like, and yet we don't have much by way of specifics. And I think that excess reserves are going to become part of the Fed's mandate over the longer run. So in addition to, and which is how it used to be in the past, I believe. So, I don't know. Miki's kind of puzzled.
Okay, so let me make the following observation. That was all really articulate, and it's obviously a very complex problem, okay? But hasn't the Fed boxed itself into making things much more complex than they really need to be to conduct monetary policy? Okay, so for 95 years, from 1913 to 2008, the Fed managed the effective funds rate through a corridor system. The FOMC would give the New York Fed operating desk the mandate, and they managed the effective funds rate. And there were virtually no excess reserves in the system. And then, beginning last week in November 2008, the Fed moved to aggressive QE, and Bernanke said, this is, extraordinary, it's temporary, we'll unwind it. And then they kept on adding more and more and more. And so when you have such large excess reserves, they switched to a floor system rather than a corridor system. And the reason why they switched to a floor system for managing the effective funds rate is they say, so now we won't have to intervene on a discretionary basis. So what happened in September is exactly what they had been saying we have to do so that type of thing won't happen. And I think the Fed's just made things way, way too complex, and they really haven't explained carefully how maintaining such a high level of excess reserves is working to achieve their dual mandate. Nor have they explained that in the context of paying IOER, and the list goes on. And so I wish the Fed would step back and say, okay, we've been given a dual mandate by Congress. Have we articulated it the right way in our long-run strategy? and are we going about operationally achieving it in the most efficient operational way? And I don't think they have, and I think they know they've boxed themselves into a corner.
Lou, do you want to jump in?
There's not enough time.
Okay. All right. Well, in that, then let me ask you, each of you have 1 minute to answer this very simple question. How will the U.S. elections affect the economic and market outlook?
I'll just make one observation about that. I think the thing in the investors I talk to, I don't think they fully appreciate how much the debate on economic policy has moved within the Democratic Party. A lot of people have this image of what economic policy was like under Bill Clinton and under Obama, and it's, regardless of who the nominee is, it's going to be different.
Miki?
Let me put things in 3 buckets. If a moderate Democrat is elected president, it won't have much impact. May boost confidence. I think it would lift the stock market. If Trump is reelected, however distasteful, it'll be kind of more of the same in the marketplace and the economy. If you were to get a hard left candidate, and I'm in the middle of doing a side-by-side of all the candidates on their economic platforms, and when I'm talking about hard left, not just raising taxes and spending, but fundamentally changing the economic structure, it could be quite jarring. And to Lou's point, I think this is what you're getting at. If you look at
I think any Democrat, I think Joe Biden would have that.
would what?
Would have that agenda. I disagree with your notion that there's a material difference between them.
Oh,
I
really?
think that's overstated.
If you look at their official websites, and I'm trying to take them literally.
That's fine. I'm just.
But this brings up another point, of course. If you go back through history, as frequently as presidents have actually followed their platform when they become president, just as frequently they do the opposite.
Just one last chance.
My concern, ultimately, I think it really depends on not just who gets elected to president, but also what the, who's in charge of Congress and the Senate. I think if you have the same divide that you have right now, where the Senate is Republican and the House remains with the Democrats, I think it's going to be another 4 years of nothing getting done, except executive orders.
Thank you. Please join me in thanking our distinguished panel for their excellent contributions. Just the last word. We hope to see you again. We have 2 more events this semester. On February 19th, FDIC Chairman Jelena McWilliams will visit us for a fireside chat with my colleague, Professor Richard Berner. And on March 3rd, we'll have another chat with the head of the Federal Reserve System Open Market Account, Executive Vice President of the Federal Reserve Bank of New York, Lori Logan. Hope to see you again soon. Thank you.